Hi, Corey. How are you?
I'm good. How are you?
Good. First, I want to introduce you to those that may not know you. You're Cory Parker. You're a sales manager at Annie Mac. We shared an office space for the previous 7 years, and we did quite a few transactions together.
Yes.
What we're going to do today is a little Q&A in regards to what's going on in the mortgage world. I think there are a lot of buyers and sellers that need to know what's going on for those that need to sell in the coming months and dealing with our new normalcy. So maybe we could start off with where we're at today and kind of how we got there.
Sure. I'll start by saying, as I'm sure people probably can imagine, the market is extremely volatile. The industry is volatile right now. Just a little quick history lesson. About a month to a month and a half ago, kind of pre-coronavirus, the industry saw a surge down in rates where, we got to pretty much all-time lows. What that did to the industry is the amount of volume that we put in about a month's time frame into the industry was more than double what we did all of last year. So,
Wow.
more than double the business in about a month's time frame. So what does that mean? It created a capacity issue where all these lenders, some lenders stopped taking refinances. Some lenders were saying, the turn times were going to be 6 months. So it created a huge capacity issue because you only have a certain amount of employees that can process and originate these loans. So it sort of a backlog. What that did to rates is it kind of artificially increased rates where, when you look at, interest rates follow the 10-year treasury and the MBS coupon. And when you look at that information, the rates should have stayed super low, but they didn't. They increased.
Can I stop you for a second and just say when did that happen?
About 5 to 6 weeks ago now, so a little over a month ago. Like I said, probably right around or just before this whole coronavirus, people started to hear about it, but didn't really know what it was and didn't have nearly the impact as it does today. It's kind of pre-corona, okay? But it does segue into this. So, the capacity issue happened. The amount of volume in the industry was humongous. So what lenders started to do is artificially increase their interest rates, where they were basically saying, hey, I'm not going to say no to originating loans, but maybe I can kind of turn people off if the rates are, if you're thinking rates are at 3%, but they're really at 4 and 4.5. So it kind of turned some people off, which I think, allowed for the industry to kind of collectively catch their breath. Yeah, process the loans that they had in process, get things under control. And, the other thing too, with the, investors, there's only a certain amount of money available. Money has to come in before it goes out. So if you have money continuing to go out with new loans, you don't have any money coming in, you can only lend a certain amount at a certain amount of time.
Makes sense.
Yeah, so that created kind of a backlog, and that kind of segued into this whole coronavirus. So when it first started, people saw the writing on the wall, what this meant. Obviously, with the news, we see how it's affecting people, how it's affecting families, employees, specifically to the mortgage market. We kind of anticipated what we're seeing today, and I'll kind of speak on that quickly. What we're seeing now is, as of 2 weeks ago, the unemployment filings in a week was 3.3 million people.
So I read something today that it was 6.6.
So 2 weeks ago, it was 3.3. Last week, it was over 6 million. So, the problem, and prior to this, I believe it was the 80s, the highest unemployment filings in one given week was 675,000 people. So massive people unemployed. So this kind of leads into where we're at today with the market. Now, when a company like mine or, any company, we originate a loan, for the most part, sometimes we portfolio the loans and we keep them in-house. But the majority of the loans get sold to servicers. So, you know, what happens is, you know, the mortgage company pay their staff for processing and originating, pay the originator for creating the loan, and it's kind of paying up front. And then, you know, they'll sell, you know, at a premium, a portfolio of loans to a servicer. So the servicer, you know, their job's not originating the loans. It's just collecting the payments, escrowing the tax and insurance, paying the tax bills and insurance bills when they're due. So right now, if you kind of take a step back for a minute, if you know, like we said 2 weeks ago, 3.3 million people, you know, filed for unemployment. This past week, it's over 6 million. What does that mean now? So that means there's going to be people that can't make their mortgage payments, whether it's they just stop, which I do not recommend. If you have a hardship, which is completely understandable, contact your servicer. Okay. Don't just stop making mortgage payments. You have to qualify for these forbearances that you're hearing in the news every day. So contact your servicer on that. But kind of getting back to the point where, so every month you make a mortgage payment, the servicer has to pay a security for that loan. Now, when someone goes into a forbearance, and let's say it's a 3-month forbearance where they're not going to make a mortgage payment for 3 months, the servicer still has to pay that security. So, you know, basically what's happening now, and you know, the industry, I heard a stat, and I don't have it validated, but you know, if 25% of the people that carry mortgages now don't make payments for a period of time, the servicing industry has about 2 months, you know, without any help, and that cripple the servicing industry. So normally when you take a pool of loans, you sell them to a servicer, the mortgage company makes a premium. Okay. Now what's happening is, you know, and I'll give you an example. I'm going to hire you at, you know, an hourly rate job, and it's going to be $15 an hour. I'm going to pay you. In a normal situation, okay, you make $15 an hour for your work. Well, what's happening now is the servicers are basically saying, I'll give you that $15 an hour, but you got to give me $3 out, you know, an hour back. So you know, if a mortgage lender is paying their staff and overhead to originate the loans, now to make that money back and selling the servicing rights, what the lenders are kind of being faced with is they're also, you know, the servicer is saying, I'll take the loans, but you have to pay me to take them. Whereas normally it's the reverse, the servicer's paying. So it's creating a kind of a mess on the servicing side, which has a direct impact to rates.
Makes sense. Makes sense. So what are you seeing on a day-to-day basis? You know, are appraisers able to go out and look at homes? Are you able to write loans? What's going on in your day-to-day?
So, you know, and I can speak for myself and my company personally. I know, you know, different companies have different outlooks and different guidelines that they're applying to this kind of situation. What I'm, you know, first and foremost, business as usual for us on the lending side. What's really changed is kind of, you know, so I mentioned the backlog. So our turn times are a little more delayed. So if, you know, closing a loan in 30 days was the norm, maybe it's taking 45 days. So it's a little bit longer, just for various reasons. One is the amount of, you know, volume in the pipeline. And number two is kind of what you were asking about is appraisals. If you need an appraisal, all these appraisers with all these refinances have been swamped. So there's been some delays in appraisals. One of the good things kind of coming through this, when you originate a loan, if there's favorable information, good credit scores, substantial equity in the house, somebody could get a property inspection waiver. So basically, there's a desktop system that takes into account the address and the value of the home and the loan parameters. And if it checks out from this system, they'll say, okay, you don't need to get an appraisal. So that's one good thing that's been more and more popular. We've had that coming for a while now, but it's getting more popular during this time. Some of the other things that are allowed are either, you know, that's what they call a desktop appraisal, drive appraisals. You know, I know in the past we had just, you know, if the house is there, the appraiser doesn't need to go into the house if, you know, that borrower, whether it's a buyer or a seller, or homeowner in a refinance, if they don't want somebody in the house for obvious reasons, you know, they could elect potentially to get a just drive-by appraisal. So they would send me an email or, you know, put something in writing to me saying that I don't want anybody in my house. And, you know, I elect to go with the drive-by appraisal.
Great, great. What are you seeing for rates right now?
The $1 million question, right? Everybody has a question. So extreme volatility. You know, kind of, there's good days, there's bad days. You know, the market's been volatile for a while, but, you know, when I say for a while, like if you look last year, that was calm waters compared to where we're at now. Rates sometimes change 5-10 times within a given day. So if I told you this morning and you said, think about it, and I'll get back to you by the end of the day today, that rate could have changed multiple times. And what I told you this morning may not be there in the afternoon or evening. So extreme volatility, rates overall are still good right now in the short term because of the servicing issue I mentioned. You know, you can't originate loans at such a low cost and have to pay your staff and have to pay the servicing companies. So that's impacting rates right now. The rates you're starting to see, you know, they're still in good shape overall where you're in the 3s and 4s in certain areas or certain criteria. But a lot of what you're seeing now is people having to pay points. That term, basically points is like prepaid interest. You're paying interest at the closing to save on interest over time. So that money is kind of offsetting the uncertainty. There's a little upfront money, you know, being taken in to kind of offset the risk going forward, whether it's servicing or the investors. So
great information, Cory. So now I'm going to ask another question, and I know we talked a little bit about this before, but you know, I know you mentioned this is a little different than the recession of 2008, and maybe you can elaborate on that a little bit.
Sure. You know, in 2008 we had an industry problem. Whether it was the lending side, the borrowing side, you know, point fingers does nothing. I mean, I think it was everybody involved. Created an industry mess. And right now, our industry's good overall. We're dealing with many different issues as it relates to the virus. So the industry as a whole is in really good shape, but in the short term with this virus going on, it's creating many different problems. So, you know, kind of if I forecast is, you know, when we see this virus not over and done with, because I think that's going to take a while. But when we see kind of, you know, some progress being made, better testing, you know, a vaccination, which could be longer term. But we see, you know, the flattening of the curve, and we see this going down and kind of being able to manage it. So people start going back to work. This, in 2008, it was an industry problem, so it had to correct itself. Whereas now, there's certain programs that are, you know, being changed, and, you know, some programs have been suspended or eliminated altogether. But as a whole, once we start seeing progress and we start seeing people go back to work, you know, from what I've seen and what I've read, we're in for a pretty good ride in the mortgage industry, pretty good rates. And like I said, you know, the programs are still going to be there.
Right. That's great information. So now what about like FHA loans and jumbo loans? Can you talk a little bit about them?
Sure. The FHA, you know, there's a lot of, you know, misinformation. I've heard different things. So government, you know, not just FHA, but USDA and VA loans, just government loans altogether, they're still as usual. Okay. Some companies might require their own personal overlays. So the government lays out certain guidelines to qualify for a certain loan. Those are universal to any lender. But a lender can make a decision on, you know, if they want to put a credit score requirement in there. So, for us, we're still lending with credit scores down to 580. The pricing is a little bit of a challenge right now because like I talked about with the servicers and the points, lower end credit scores, but it's still business as usual. So the government loans, the government hasn't changed their stance or suspended their, lenders might have suspended their own originating and processing of these loans, but the government itself has not stopped.
Great. So this is all great information, Cory. I want to thank you for taking the time to answering these questions for those buyers and sellers that really may need to sell during these tough times, whether it's a relocation or maybe, family dynamics have changed. There's always those reasons why you may need to purchase or sell in the coming weeks and months. And so knowing that you're still business as usual, or our new normalcy, so to say, we're all here, trying to work together and kind of help each other out and help people get to where they need to go.
Yeah, I think the forecast for, the real estate market, we have our obvious issues now where people are quarantined, people are losing their jobs. So in the short term, that's affecting, your real estate market, which is obvious. But going forward, like I said, once we kind of improve this virus situation, the market's still going to be there. This is not where, there's no demand. As there's still a ton of buyers, whether they're, stuck in their house right now, in a month, 2 months, maybe longer, who knows? The market's still going to be stable, I believe. I truly believe that this is just kind of a short-term thing. It's not going to be a long-term. I've gotten a lot of questions on that where, is my house value going to decrease? Is now a good time to buy? The other flip side of the coin is if you're a buyer and you're looking right now, there might be less competition out there.
That's great. Multiple offers may get you in that property that you want to be in.
Right. Yeah. I've had a lot of clients kind of look at that silver lining and say, well, I've been looking for the last 6 months to a year to buy a house. And every time I'm getting outbid or there's multiple offers, some of those people come back to me now and said, hey, now's a good time because, maybe there's not as many offers. Maybe the competition isn't as high. So it's still, business is still going. It might be a little bit slower right now for obvious reasons, but I think all in all, once we get through this, as an industry, we're very healthy.
Awesome. So thank you for taking the time today. I will definitely share your contact information for those that have questions on refis, looking to kind of move forward with a loan and such. So thank you.
I appreciate it. Yeah, feel free to reach out with any questions that I can help with, even if it's not to purchase or refinance. If you just have questions on your existing loan, if there's anything I can do to help, I'd be more than happy to do so.
Great. And maybe we can check in a couple weeks or so and kind of see where things are at.
Sounds good. Yeah. If anybody has questions that we might want to answer kind of, on a more visible platform than a one-on-one, please submit questions and we'd be more than happy to answer them.
Great idea. All right. Awesome. Have a great rest of the week, Cory.
Thank you. You too.
All right. Bye-bye.
Bye-bye.